Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. If you like making money, click subscribe. I'm going to look at a whole bunch of usually commodity type investment opportunities. Sometimes I do financial education type stuff like this one is. One thing that has me concerned is the ore grades are declining in some of the minerals. They're getting pretty low. And the energy inputs to those miners, I should say, are increasing exponentially. And that's one thing I look at, and that's why I position myself with physical metals, and then I also have mining companies. I have a diverse, wide array of mining companies. I have some juniors with low ore grades. I have some senior producers with very high ore grades. So the senior producers are going to print money with their higher ore grades. As the prices move up, the cost curves are going to move way up. Their energy inputs are going to move way up for those higher cost producers. And if we are transitioning to a world where we are finding less and less ore grades, that means that the cost curves are going to move up rapidly. There's some ways that we can play this. The royalty companies get a percentage of what's produced. So the costs can continue to go up, and they're going to print money. So one of the strategies that I have is to invest heavily in royalty companies because they have no input cost problems. Those are the problems of the mining companies. They make money off of the royalty streams from the mining companies, and they get a certain percentage of net smelter value. Or they may have other in their contracts to say we can buy a certain amount at a certain price, a certain percentage of production, and they may do it through that way. But they're not subject to the increasing input costs and the declining ore grades. They are saying we are just going to have a percent. We will give you a loan. We need a certain percent of your production output. So that's how they have it. So ore grades and energy. Let's jump in here. Let's see what I've got. So the average ore grades. Typical mines today have ore grades of only 0.6% copper. Average grades were 79 ounces per ton of silver, 2,240 grams per ton of silver, and 0.118 ounces per ton of gold, 3.35 grams per ton of gold. And if you're looking at some of the junior mining companies in silver and gold, right now, they're lucky to get 1 gram of gold per ton, and silver is below 1,000 grams per ton. Some of them are like 300, 200, 100. They keep going down. Nickel ore grades are estimated to average is 6%. Uranium grades average from 0.07 to 0.035% in the world. The Canadian area in the Athabasca region has the world's largest deposits of high-grade uranium with grades of up to 20% uranium, which is 100 times greater than the world average. So how much energy consumed today, just to let you guys know, I'm talking ore grades and energy consumption. So approximately between 8 and 10% of the world's total energy consumption is dedicated to the extraction of minerals, making the mining industry one of the most energy-intensive industrial sectors. This energy is used to extract and process the resources, including a variety of concentration and refining processes. Several geological factors can influence this energy consumption, the concentration of the minerals in the rock being one of the most critical. So the concentration of the minerals in the rock being one of the most critical to energy consumption. So one thing I want to make sure here is everybody understands that energy consumption is not linear. While the average concentration of copper is slowly decreasing over time, 25% from 2000 to 2013 for the Chilean mines analyzed, the total energy consumption has increased 46%. So we declined 25% from ore grades, from the concentration, and the energy input increased 46%. Additionally, an exponential relationship can be observed between these two factors, concentration and energy consumption. As when the concentration decreases, the energy needed increases exponentially. So I've got a graph here. This is what the graph looks like. We've got a line here that's fit to the data. We have another line. This is the mine plus concentration plus smelter plus refinery. This is mine and concentrator. So if we look at this line here, it is starting to turn on up. A lot of the projects are falling in this 0.6% region. And remember what I said earlier, that is the average for copper is 0.6. But if it's the average, that means that roughly 50% are below 0.6 and some are above 0.6. And with time, we are adding lower and lower ore grades. And when we add lower and lower ore grades, and we start getting below 0.5, 0.25 to 0.5, this thing goes vertical. The energy consumption, the energy intensity, the ore grade down here is the x-axis, the energy intensity is the y-axis. As we move down in ore grades, the energy starts to move exponentially to the upside. What does this mean, right? It means we're going to be using a lot more energy, and the cost curves are going to go way up with time. So if energy goes up, the cost curves go up even further. So the takeaway here is, if we try to obtain a lot more copper in the world and the ore grades are below 0.6 to 0.7%, which they are, we are going to put the pedal to the metal on oil consumption. The relationship of ore grades and energy consumption, again, are not linear, but in fact exponential. If the world consumes 10% energy to mine today, we could easily increase this figure if we try to drastically ramp up low ore grades around the world for copper and other metals. So if we go and try to do the renewable world and we see this gigantic demand for copper, we are going to ramp up our oil consumption like mad. Because remember, if we are going to put online lower ore grades, the energy consumption is not linear, it's exponential. We could be expending 20% of the total. This mining sector could become 20% of the total energy consumed. It can go up substantially. So how do we invest? What do we do with this information? We need to look for projects that have high ore grades. That's one thing. We can invest in companies that already have large reserves and good ore grades. We can hope for technological improvements to extract lower ore grades, which will help all of the companies out. Buy physical metals and protect yourself against a really steep cost curve increase. You could do that with physical platinum and silver. Those are the two that I have. Now here's the top 5 highest grade open pit copper operations. We've got First Quantum, Glencore, MMG, and Ivanco. These are the copper grade in reserves. And the thing that sticks out to me is Glencore has a high copper grade, and they've got copper in ore resources that are massive with a very high copper grade. So Glencore is one that's on the top of my radar. I think that's a pretty good one to look into. They also have a bunch of nickel. So those are two metals that I really like. And Glencore has really jumped up on my investable, a company that is worth investing in. Glencore has jumped very much to the top. But First Quantum looks pretty good too. All these right here look very good. But I like this reserves here. The reserves and the copper grade. Very nice. These are the operation when it started, the major owner in the country, and then look at the mine reserve copper grade. These are the percent copper grade. This KGHM looks pretty good at 1.5%. But I would say Codelco's got a couple good ones. Anglo Glencore's got 0.8%. That's still pretty good. 0.94 Glencore BHP. This is a good one here. So that looks pretty good. We've got the mine life over here. So Glencore's got a relatively earlier mine. The Glencore one up here is 70 years. This one's pretty old, Anglo and Glencore. But a lot of these are pretty old. And the copper grades are not extremely high. They're actually, 0.25, that's pretty low. So I wanted to share this with you guys. It's not a linear relationship. It's exponential. So as ore grades decline, energy input goes up exponentially. I've always worried about this. I didn't do too much research into it until recently. I'm just looking to see how, if we're trying to pile on the mining, and we've got exponential increased use in energy, you're going to see a huge oil boom, massive. Because if it's 10%, so let's just do some easy math. If they're 10% of the total energy, let's just say that in oil, they're a little bit higher than that. Let's say they're 15 million barrels of use goes to mining, 10 or 15 million barrels per year. If it's 10, make the math easy. Let's say it doubles. Where are we going to get 10 more million barrels of oil in this next we'll say next 5-10 years? And then if we continue to see this across the entire spectrum, and let's say we have to really ramp up our copper use, and copper seems to be the one in the worst situation in terms of ore grades, we're going to be putting on a whole bunch of low ore grade projects. If that's the case, our energy use is going to ramp up quite substantially to the upside. So oil could have problems and could have very high pricing if we try to ramp this stuff. And with Biden and all these other countries wanting to go to a green, renewable world, this is going to be very interesting because, one, they're going to emit a bunch of carbon into the atmosphere in order for that to happen, because you have to mine all this stuff first. And they're going to have to mine this stuff at ever greater quantities, which means we're going to even dump more carbon into the atmosphere and use more energy. Very interesting mix here. So what I'm doing is I'm looking for projects with higher grades that could potentially come online in the future and maybe put a little bit of money in those for a speculation play in copper. If you guys like this content, give me a thumbs up. I appreciate you guys listening. This is Finding Value.